And one of the dangers of the bubble bandwagon is you say, well, it's a bubble, I'm going to sell it. Almost everything that we look at when we go through and look at when you identify it, the best course of action is to buy it, not sell it, because it goes on, right? And so, again, you don't want to be Sir Isaac Newton selling early and then buying at the very end and losing everything, right? So you kind of just have to. It's emotionally very hard. It's a struggle, but it's important to have a game plan when you go into it.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice, because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, October 24th, 2025, CPI Day. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
So I'm in my grunge wear today.
I was going to say, you look very autumnal today for...
Thank you.
It looks like suburban autumn. You don't look like you're going to chop down any trees. You look like you might go get a pumpkin spice latte somewhere in your,
This is my ode to the concerts. I was at a concert last night. I went to see this guy Jack Wilmot at the Paramount, who's a great new singer.
It looks like you went to see Yo-Yo Ma in that thing.
Well, if you like Jack Johnson, if you like Gavin DeGraw, if you like Mountjoy, this guy is right up your alley. So it's a fun concert. Oddly, I was in a suit last night for that, and now I'm in a grunge wear for this podcast.
You have your LL Bean shoes on?
Yes, the boat shoes or whatever they're called. Anyway, lots to get to today. CPI, obviously the headline. Maybe we start there, Neil. Any thoughts? I'm sure you have a couple.
My first thought is there a reason why they released this and not the employment number for September? Just saying, not a conspiracy theorist, but shockingly, everyone, the CPI number came in much better than expected in September. Absolutely, obviously, all other data is, not allowed to go out during the government shutdown, but because of the tips market and cost of living adjustments, you got to get that CPI data out. And Russ Vought did the president a solid by letting that number go out and by calling these BLS people back to work, because core inflation rose 0.2%, better than market expectations. I think the tariff worrywarts will look at this and they'll find evidence for tariff consequences in the inflation data. But I'm always reminded of that scene from The Social Network with Jesse Eisenberg. We've all known the movie. It's a movie about Facebook, right? And he's sitting around the table during a deposition and he's like, and he's getting tired and he's like, look, this is really simple. If you guys were going to create Facebook, you would have created Facebook. It's the same thing with tariffs. If it was going to create inflation, it would have created inflation. And look, what you're seeing is really relative price shifting, nothing beyond that. The level of prices doesn't appear to be going up in any significant way. So you see core goods inflation has perked up a little bit. But the big news in the inflation data is the fact that core services inflation has been cooling off. And that's primarily a function of what's going on in the rental market. So we had very, very weak growth in rents. Score one for Governor Steve Myron. He's been talking a lot about that, basically making the point that immigration enforcement is putting downward pressure on rents. I think it's probably also a function of the jobs market, to be honest. You have weaker employment growth that's weighing on rents. You see that across a number of apartment REITs. They're all talking about weaker rent growth, and you're starting to see that in the data. But remember, if market-based rents are slowing, that means that the CPI is probably lagging that. So there's probably more disinflation in rents in the pipeline. We also saw weakness in food away from home inflation. Remember, food away from home tends to, it counts into the core PCE number, right? While it counts in headline CPI. The reason being is that food away from home, which is restaurant prices tends to be more labor sensitive than commodity sensitive, which is why that happens. But you saw weakness in food away from home as well. So that's like restaurant menu prices are slowing. Again, that's a sign that maybe demand is weak. But, the inflation data kind of confirmed my priors, which is why, kind of cements an October cut probably means another one's coming in December. So all in all, it doesn't show that tariffs aren't having an effect on consumer prices. It just shows that it's mostly a relative price story, not overall inflation.
Well, tariffs are certainly having an effect on President Trump's view of the world, since he was a little angry and pissed off the folks up in Canada.
Yeah, I think
a little sensitive, isn't he?
I think he's right to ignore it, or for the market to ignore it, rather. I mean, what he sort of said was in response to an ad run by the Canadian province of Ontario showing Ronald Reagan critical of tariffs. He sort of accused them of trying to interfere and influence the Supreme Court ahead of the November 5th case regarding his authority to impose tariffs under the International Economic Emergency Powers Act, IEPA. Actually, those tariffs are the ones that apply to Canada. And right now they are at 35%. The number in terms of the bark being worse than its bite is probably important here, because we talk about Neil mentioning maybe the muted tariff effect so far, and that's because the effective rate is much lower. I believe for Canada and Mexico, it's actually closer to 7%. And that's because imports that comply with the United States-Mexico-Canada agreement are exempt. And according to the Canadian readout from the meeting Prime Minister Carney just had with President Trump on October 7th, 85% of Canadian imports are not subject to any tariff. So I think that's probably why. So why did he do it? He clearly angered and irritated by it. But to me, he's also going on this trip to Asia right now to have a lot of trade and tariff discussions. And so if you want to sort of send this FAFO, I'll use the word fool around and find out, in case any kids are listening. I don't know why you'd be listening to the show in front of your kids. You're not going to parent that you're doing that. But regardless, there could be some element to that, just sort of trying to set the tone here where, hey, if I'm willing to be a little volatile, a little unpredictable with our neighbors to the north, what do you think I'm going to do with you? So again, trying to maybe assign some method to the madness, whether it's warranted or not remains to be seen. But definitely next week, we're going to get a lot of trade headlines around President Trump's trip.
I would say, though, I do think the president, to be perfectly frank, is on firm ground when he basically says that the government of Ontario is misrepresenting the words of the Gipper. I mean, let's be clear. Ronald Reagan did put significant tariffs on to protect the U.S. auto industry, right? I mean, and ultimately, that's one of the reasons why the Japanese producers make the cars here, right? So, look, I mean, I think it's just interesting. I mean, I would just say that while tariffs are an important animating part of the president's agenda, it's not unusual for a Republican president to actually put tariffs on. I mean, we all remember back in the early 2000s, W kind of going before a bunch of steel workers and telling them that he stood up for steel because he put tariffs on steel. Now, he still was able to squeak by, and everyone kind of thinks he's a free trade president. But I mean, history is littered with examples of Republican presidents putting tariffs on. Trump wasn't the first.
Two things I'll just say to that. I agree with Neil. Is when the tariffs go on, they very rarely come off. And if you look at just a lot of the trade actions that have sort of the number and the frequency have really gone up just in the last few years, but they seldom come off because you develop these political constituencies. One of the things that Reagan warned about, I believe in the ad, was that it will cause other countries to retaliate. You go back to where were the economic dire forecasts that were predicted prior to April. What was the assumption they got most wrong? It was anticipating that these other countries and trading partners would retaliate. They didn't. They chose to negotiate. Now, that may be uniquely attributable to President Trump in his volatile nature, but trying to avoid that. But whatever reason, I believe that's likely to hold. And I think that's one of the reasons, again, these more dire forecasts did not come to fruition.
Well, these markets seem not to be paying a lot of attention to these things. Jeff, you've got, the seasonality versus sentiment. You've got a lot of things going on. Where are you falling down?
I always thought FOFO was an inventory accounting method. Well, look, seasonality, to put a precision on it, and you never want to be, and let me rant on this a little bit. I think there's a lot of interest in this business of precision. And I think that is a big mistake. This is not a precision business. This is an accuracy business. And so I think you have to ask yourself when you're investing, do you want to be precise or do you want to be accurate? And I would just say you want to be accurate because you can't be precise. And so if you're striving for precision, you're going to end up actually making bigger mistakes than if you're just accurate. So we'll let people drink a scotch and think about that one. Look, I think, from a seasonal standpoint, getting to precision, you have it fell on the 23rd this year. October 23rd is the single best day to be a buyer of equities for the next 3 months historically. It's not to say that'll happen this time, but historically, if you were to put a date on it, it's X number of days from the last trading day of October. So you're in as good a sweet spot for equities as you can get. You're actually in a similar sweet spot for gold. You're specifically in a very sweet spot for cyclicals versus defensives. So those all kind of translate into the same thing. We'll see, but you do have obviously a strong seasonal tailwind here. I don't think sentiment's enough to derail things. We had enough of a correction in some of these high flying tech names, high beta tech names. I think that cause people to feel a little uncomfortable. Maybe it goes on, but we'll see. I still think that we're set up for a decent rally into the end of the year. The one area that's a little different than that is gold. So gold flashed in our bubble work. And we actually got at the beginning of the week the excesses in inflows in the gold ETFs. And what that says is that the amount of assets coming in as a percentage of total assets is in the zone that historically kind of creates this crescendo effect where the ability to continue to outperform goes way, way down. So it's a signal to be cautious and take some money off the table, which we advise clients to do earlier in the week. And I think that continues. So that's where you've got sentiment fighting seasonality. So I do think that you're going to end up with more of a consolidation, very similar to what happened in April with gold. We had almost the exact same setup. Now we thought gold would get oversold. It never did. So we sat on our hands and then bought the breakout through 3,000 back at the end of the summer. But here's another opportunity where I think it's going to consolidate and kind of burn off some of this enthusiasm and excess. So we'll see. Keep in mind, the one difference here is that gold did reach the bubble characteristics. That was not the case in April. So we have to be vigilant and mindful of that. What does that mean? How do we think about that? The reason it's important to identify a bubble, I'll talk a little bit about how we do that, is that bubbles are inherently V-tops. They go up and they go down. And I'm sure most people are going to think, well, that's what happens to every stock and every market. And that's not really what happens. You go up, what they call in my side of the business, distribute. There's kind of this tug of war between buyers and sellers. And then the sellers kind of take over and then the trends turn down and you've got a downtrend. But that's usually a process. A top is usually a process. If you're in a bubble, it's not a process. It is. It's just very sharp, right? And so it kind of sucks the oxygen out of the room and then just expels it, and with it profits and everything else. The problem with that, or the importance about identifying that, is that the traditional techniques of, say, stops and moving average crossovers and all those things aren't inherently useful because you give up way too much of that profit and that gain. So you have to be a little tighter on the way that you manage that money, and that's obviously how we're advising clients right now. To think about that. So one of the things that we look at is just simply. It's pretty easy, but it's effective, which is, does the asset in question double in a 2-year period? And if it has, If you go back and look, the Dow in 29, the Nikkei in the late 80s, the NASDAQ in 99, 2000, all those that you'd consider bubbles, actually saw doubling in 2 years. Gold did it. So that's, why we're on alert with that. That doesn't mean that that's the peak. So I think that's really, really important. I had a call with clients yesterday, and somebody's like, well, I'm like, it doesn't mean it's the peak. It just means you are now in a situation where you're likely to have a V top. And so you need to be thinking about selling into strength, which usually we don't do because we let profits run. You have to just change your mindset in the bubble to try to hold on and then not be in a position of emotional weakness where you're kind of the last sucker in saying, okay, I can't take it anymore, and I buy it, just like Sir Isaac Newton did, which we talked about. I don't know if we talked about on this, but we talked about it in the survival guide. So that's where we are with gold. You might be there a little bit with semis. There's an asterisk there that we've talked about with clients, but just to give you some perspective on that, if the NDX, the NASDAQ 100, were to be in a bubble, by that definition, we'd need to be at 35,000. So we're not, just as a reference. So that's a long way to go from that. As a reference, the NASDAQ right now, the NDX, I should say, is at 25,000, right? So you need to put another 1,000 points on it, basically 40% more to get up there. So, you'll have pockets. And again, it doesn't mean that it's not a top. You don't have to have a bubble to be a top, right? It's just the way that you characterize it. I don't think it's a top, but you characterize bubbles by, certain definitions. And it's important because you have to play the game differently if you're in that scenario.
You had in your weekly survival guide this week, you had a great table for our clients that had, the bubble watch. You looked at markets, macro sectors, you looked at industries without giving away all the goods. Was there anything else beyond, you mentioned gold, you mentioned, the NDX, anything else on that sort of struck you as, oh, that's surprising. It's getting close.
Well, semis are there. But semis, I think the one thing that's curious about semis, and I haven't done the work to go back and look at it, is we had like a 30, maybe 35% drawdown within that 2-year period. And usually if you have a big drawdown like that kind of nullifies the quote unquote bubble because you reset sentiment, you reset expectations. So I have to go back and look if you've had, sort of drawdowns like that. But those are the only things that really stand out as potentially, in that definition, right? So again, like every bubble is a top, but not every top is a bubble, right? And so you can have tops that aren't bubbles, and I want to be very clear on that. It's just we want to identify them because we have to change the way that we approach those and that we protect profits in those environments. But I say it as well because I know, to come out, Paul Tudor Jones has talked about it. He also talked about, doubled in 6 months, and that's true. But, people are kind of trying to jump on the bubble bandwagon. And I would just say that definition leaves a lot of room. And one of the dangers of the bubble bandwagon is you say, well, it's a bubble, I'm going to sell it. Almost everything that we look at when we go through and look at when you identify it, the best course of action is to buy it, not sell it, because it goes on, right? And so again, you don't want to be Sir Isaac Newton selling early and then buying at the very end and losing everything, right? So you kind of just have to. It's emotionally very hard. It's a struggle, but it's important to have a game plan when you go into it.
But to reiterate, I think you said this last week on this pod. I certainly said it to our clients. It's tough to pop a bubble when rates are coming down, right? That's generally
100%. Show me one that has really deflated without some problem within the credit markets that is seeing a tightening. It's preceded by, and it's not preceded by like a week or two. It's preceded by the Fed and banks and the lending standards are all really trying to kind of hone things in. They're trying to take away the punch bowl, and that's just not what's happening here.
All right, let's move to the mailbag. Morning, Harry.
Good morning, everybody. So today we have the question come from Justin Fargo. His question is there any evidence of pent-up demand in the housing market from an economic standpoint that we can easily quantify? Thank you very much.
I think that's all in your wheelhouse, Neil.
To quote our great presidents, the accent, I can't understand it.
Wow.
It's the accent. Well, if Trump can say that, how come I can't say it?
We didn't say you couldn't.
You just did.
You guys are just shaking your head like I stepped on like a friggin' spike or something.
I didn't expect it from you. That was out of character.
I think it was a question about pent-up demand for housing, right?
That is
general
correct.
vicinity. Well, I would just say that I think the main story is that, like, what do we mean when we say like pent-up demand for housing? Because we've sort of, on a demographic basis, we've been undersupplied really since, like, people have been talking about that for 2012. Like, why are we even talking then about home prices moderating in many parts of the country if we've been undersupplied forever? So it's really about, like, at what rate and at what price are we undersupplied? And I would just say, like, there's not much pent-up demand here. Interest rates are not yet at a point where whatever pent-up demand people are talking about is being unlocked. I mean, to me, the big story right now is that even though mortgage rates have been coming down, we have seen builders sitting on additional unsold inventory. We've been seeing prices come down. We've seen the builders tell us that they haven't really seen much of an impact in demand. So I hear you. I mean, on undersupplied, but I just think that there are clearly other factors at play that are keeping the housing market from perking up.
What do you think the number is on interest rates that get things humming?
I think mortgage rates need to be probably around 4.5% to 5%.
Really? Wow. All right. That's significant.
I mean, there was a major public builder today, this week, Meritage, I think, that they were talking about buying their buying rates down into the high 4s, and that still didn't do the work. I mean, they're still talking about how demand is sluggish, even though they've been buying people down to those rates. So, ultimately, it comes down. I mean, what's happening, right? People aren't stupid, right? There's a price psychology in housing. If you think interest rates are going down and you think prices will keep coming down, why would you buy now? Like, why would you want to finance an asset that you think is going to go down in value, especially at a time when wage growth is slowing, right? Like, making the math work if your wages are barely going up 3%, it's tough for anyone with mortgage rates, even if they have come down 50 basis points. Like, I pointed this out this week to our clients. Over the last 6 months, purchase applications basically flat, even though the 30-year fixed rate mortgage is down over 50 basis points during that 6-month period. What more do you need to know? The impulse isn't as strong as people thought. That's all I can tell you.
So there's a combination between confidence and rates. That makes all the sense in the world, right? I'm sure rates come down before confidence goes up.
Yeah, it's about why rates are coming down.
Right.
Like, if the bond market is saying, well, labor markets are cooling, inflation is cooling. Like, the fact that the inflation number today slowed, inflation's a lagging indicator. That means the Fed was already too tight. So what does that mean about, anyway.
Well, thanks, Justin, for that question. We'll get a hat out to you. As a reminder to people, submit those questions on all our social media platforms. That's X, it's Instagram, it's TikTok. Thank you for that comment last week suggesting that I got those things wrong. But send those questions in. We'll get a hat out to you. So appreciate that. Yes, Jeff.
Hey, way to wear the boomer outfit today, though. After the well done.
But by the way, I'm not a boomer.
Way to dispel that stereotype. Jesus.
Other than getting ready for Halloween, what's everybody watching next week? Steve?
Yeah, I'll go first. I just want to challenge one thing Neil said. Neil said people aren't stupid. I'm recording this near Capitol Hill, and I have some people close by that may challenge that. But with that, I know that the thing to watch next week is going to be President Trump's trip to Asia. We're recording this Friday. From a shutdown perspective, Democrats want to negotiate with him. It's hard to do if he's not here. So I don't really see a resolution next week on that. The thing to watch, if you just look at his schedule, he's going to the Association of Southeast Asian Nations to start the trip, and he's going to meet with leader of Malaysia, and my guess is you're going to see an agreement announced there, some details on that. One other person who's going to be attending that meeting is the president of Brazil, Lula da Silva. Trump's talked about making some progress there on the trade front. I'm surprised if we don't see some conversation there on the sidelines of that. So that's something to watch. Trump also wants to see them sign an agreement between Cambodia and Thailand. Remember, we have this push for the Peace Prize that Jeff was talking about last week. So Trump wants to be there and get credit for that as well. Then he's going to go to Japan. And he's going to meet with the new prime minister there. He's also going to go to Korea at the end of the week as part of the APEC summit. And that's important because the U.S. has announced agreements with both Japan and Korea that came with large investment commitments. I'm looking to see if we get some more details regarding those investment commitments, and I'd be surprised if we don't. And then obviously the big event is going to be Trump's meeting with Chinese President Xi Jinping. Look, my expectations are low. I would say that's the key to happiness. But, in terms of what's probably realistically achievable, given some of the escalatory rhetoric and threatened actions, I think probably just a continuation of the status quo, really just prolonging this trade truce beyond the November 10th date is probably more realistic. Maybe we see some, as part of that relaxation of the export controls, maybe China agrees to some purchases there of soybeans, but I would really just temper expectations around that. And let's just make sure the meeting happens. The thing to watch over this weekend will be the lower level meetings led by Treasury Secretary Bessent, his Chinese counterparts. Trump suggested earlier this week, there's no guarantee that he meets. I'd still be surprised if they don't, probably 85, 90% chance that they do, but it's not 100. So that's something to, I guess, keep in mind as we're looking at next week.
Is there a chance, Steve, that we're going to see you on the Keystone Sports Network again now that Franklin's gone?
Yes. So I will be on recording this today. They brought me back. I was right. Talk about low expectations. If you're a Penn State fan, that's part of the whole reason that the season went awry, that there were high expectations. Why that was the case for him, I don't know. But I'm glad that he's gone, and I'll be happy to take a victory lap during my return.
God, I mean, just an assassin.
That's amazing. It's like a mercenary. Neil, what are you watching this week?
Don't get between Steve Pavlik and his football team.
Really?
For God's sakes.
Well, we don't have any government data released as the shutdown goes on. We obviously have a Fed meeting next week. It's widely anticipated that they'll be cutting. This is a meeting where they will not be releasing summary of economic projections. So most of the story will be in with whatever Powell says at the press conference and the statement, of course. I'll be keeping a particularly close eye on consumer confidence. This is an October data point from the Conference Board, obviously. This is the series that produces the labor differential, so we're keeping an eye on that. Consumers have been talking about how difficult it is to get a job. I will point out, in the last week, Amazon, Nestle, GM, you've had a bunch of Charter Communications, Target. You've had a bunch of companies in the last week talk about layoffs and go through with plans for layoffs. Applied Materials is another one. So, I think the labor market's not out of the woods, and so it's interesting. We'll be interested to see what happens with consumer confidence because obviously stocks are at records, gas prices are down. Confidence should have every reason to go higher. The fact that it hasn't been is interesting. That leaves what? The labor market, right? So I think that'll be an interesting data point next week.
When the government comes back, just from a process standpoint, is there going to just be a backlog of information that they're just going to release, or do we just skip those data points?
I'm not sure. I mean, I think obviously they're not even conducting the survey, I don't think, for the October numbers. So we'll probably go a month where we don't even have any data. So they have to fudge that number, I guess. So yeah. That's
awesome. We'll be talking about that next year on a year-on-year comparison.
I mean, we didn't talk about it today, but I think it's kind of interesting, right? I mean, the Governor Waller mentioned the ADP number in a speech. So the ADP does work with the Fed, and they give sort of intel or just data points that they don't make available widely to the broader public. And Governor Waller mentioned that in a speech not too long ago. And now the ADP got pissed off with that, and now they're no longer providing the Fed with that data set. Powell has kind of had to come like cap in hand to the ADP, like, please give us the numbers. We need the numbers. Look. I mean, it's everyone always bitches about how the Fed is like too data dependent. Now you can see what they are when they don't have any data to begin with, and see how it works. But look, it's just an interesting kind of side story here. Nick Timrose at the Journal wrote about it, but as I say, like, the survey data is what you have to go on. All the soft data are what we have to focus on because a lot of those are private. And, next week, the main one is going to be the conference board.
Jeff?
Well, next week you've got earnings. You've got some big ones. Most of the mags are in there. So Meta, Apple, etc. But big earnings week. We don't necessarily play the earnings game. We do, but not traditionally. So we'll see how those reactions are. I expect that they're decent, but we'd be buyers of weakness if they're not. That's not a blanket statement, but just kind of generally thinking about things within trend. So that'll be important. And then looking for oversold conditions. So a lot of these kind of high octane small cap names, a lot of them were, quantum computing or materials, et cetera, rare earths. See if those get oversold and then how they respond to the oversold conditions. So one of the hallmarks for us to a developing top is that stocks do not halt when they get oversold; they continue to weaken. So it's important that oversold conditions hold. I think they will. As a preview to that, but we'll be watching that. That's always important in terms of the resilience of the trend.
Well, we mentioned a lot on this pod today about stuff that we had done for clients. Certainly, if you're not seeing our work on a daily basis, reach out to or go to renmac.com for more information. Happy to get you on a trial, see what else we do here at RenMac. But let's end it there. Next week we'll be back. It'll be Halloween, so
we have a guest next week, right?
We have a guest next week. That is correct. So
nice.
Don't know if we can divulge that name yet, but come back and watch us next week. It's Halloween. It'll be a lot of fun. But until then, I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Tablet.
Have a great week.